Gold investors. Gold didn't just spike above $5,000, it closed the entire weekly candle above $5,000 for the first time in history, even as mainstream media tried to smack it down with a fake Russia dollar story. The system threw propaganda and paper at it, and the metal still printed a 5K weekly close. I'm OG John AG, and in this video, I'll show you why this close is a real line in the sand, how Bloomberg's Russia headline was exposed as fiction, what Russia and China are actually doing with gold and silver, and why all of this is colliding with a $9.6 trillion US debt wall and $1 trillion a year in interest. By the end, you'll know why this doesn't look like the end of a bubble. It looks like the early phase of a much bigger repricing of gold and silver against fiat. Segment 1. The first ever 5,000 weekly close. Let's start with the chart. Right now, Western spot gold is around $5,040. For the first time ever, the weekly candle closed above 5,000. Not a wick, not a flash pump, a full weekly close. That matters because previous spikes above key levels often got slammed back below before the week ended. This time, sellers tried, including via a big geopolitical headline, and still couldn't close it under 5K. On a multi-year chart, 5,000 used to be a crazy target. Now it's a printed, confirmed level. Segment 2. Bloomberg's Russia dollar story and the denial. Now the headline that hit right into this move. Bloomberg ran a story implying Russia was considering returning to the US dollar settlement system in some kind of peace framework. Algorithms and short-term traders read, Russia, dollar, deal, and did what they always do. Sold gold and silver, bought the dollar, spiked volatility. Then the person who matters spoke. Russian Central Bank Governor Elvira Nabiullina publicly confirmed there were no talks, no involvement, no plan to return to the dollar system. That means the narrative that moved billions in markets was simply false. Yet even with that hit, gold still ended the week above 5,000. So you learned two things. Major outlets can still move metals with bad information. Real underlying demand is strong enough that even manipulated dumps aren't reclaiming key levels. Segment 3. Russia's no and the multipolar direction. Strip away the noise and focus on the core statement. Russia is not negotiating a return to the dollar system. That fits years of behavior, building alternative payment rails, increasing gold reserves, pivoting more trade away from the dollar when possible. This doesn't mean the dollar disappears. It does mean a major energy and commodity producer is publicly saying we're not going back to the old arrangement, even under heavy pressure. In a multipolar world, that kind of hard stance is a tailwind for gold's role as neutral collateral between blocks. Segment 4. China's crackdown on paper games. While that Russia headline distracted everyone, China quietly changed the plumbing of gold and silver trading. New Chinese rules on off-exchange gold and silver include bans on off-exchange leveraged derivatives that stack extra leverage on top of futures, mandatory physical delivery for many trades that used to settle in cash, tighter scrutiny of fractional reserve practices, too many claims per bar, a ban on off-exchange rehypothecation of gold and silver. Rehypothecation is the trick where one bar is pledged to multiple contracts, effectively creating 5, 10, 20 paper ounces per real ounce. By banning that in its own markets and forcing more real delivery, China is making it harder for banks and brokers there to flood the system with unbacked paper metal, increasing the importance of genuine physical supply versus synthetic claims. This doesn't instantly fix London or COMEX, but when the world's biggest physical buyer says no more multiplying claims on our turf, it stresses a decades-old suppression model. Segment 5. Shanghai premiums and thin silver inventory. Look at the signals from China's own exchanges. In the video snapshot, Western silver trades around $77. Shanghai spot is closer to $86, and futures near $88. That's roughly a $9 premium over Western paper. For gold, Shanghai futures are trading above domestic spot, another sign of internal stress. Then inventory. SHFE silver stocks are only about 11 million ounces. Friday's edition was just about 126,000 ounces, barely enough to avoid immediate shortages, not enough to relax. For China's industrial and investment scale, 11 million ounces is tiny. Combine, low exchange stocks, high and rising premiums, new rules forcing more delivery, and killing rehypothecation. That's a physical market under stress, with less room for games and more pressure on real supply. Segment 6. David Morgan's call and the U.S. silver angle. Silver analyst David Morgan adds another layer, his key points. Historically, about 90% of bull market gains can cluster in roughly 10% of the time, a short, explosive window. He believes silver's current bull still has roughly 1.5 years left, where that compressed gains phase could play out. He expects the U.S. to stockpile silver for strategic reasons. Why stockpile? Because of refining and supply risk. Segment 7. China's 70% refining dominance. Most people look at mining. Strategists look at refining. Estimates in the video, China mines only around 13% of the world's silver, but controls about 70% of global refined silver production. Refining is where ore becomes the 999 bars and high-purity metal used in AI hardware, advanced military systems, high-end electronics, and green energy gear. If one country dominates refining, it has a choke point on the supply chain for critical technologies. For the US, that's a national security problem. You can't run a high-tech military and AI economy if you're dependent on a rival's refineries for your silver. That's why a future US strategic silver stockpile isn't just a bullish story. It's a logical response to a vulnerability. If and when that happens, it locks metal away from the open market and adds permanent demand. Segment 8. Gold ETFs down, central banks up. Now look at who's actually buying gold. According to the video, gold ETF holdings today are lower than they were in 2022, when gold traded around 1,900. Gold is now above 5,000, but ETFs haven't re-expanded to old highs. That means retail and many institutions that use ETFs have been selling or staying flat. The big net buyers are central banks, taking delivery of physical bars, not ETF shares. So price has nearly tripled while the crowd hasn't piled in. Official sector demand has been the foundation. That looks less like a classic bubble top and more like a re-rating driven by sovereign players with retail still asleep. Segment 9, the US deficit and the 9.6 trillion refi wall. Now the macro math that all of this sits on. The numbers from early 2026 in the video. First 4 months of the US fiscal year, deficit about $697 billion. Third highest 4-month deficit ever, behind only last year in 2021. Outlays, roughly 2.5 trillion. Revenues, about 1.8 trillion. Net interest on the debt, 346 billion in just 4 months, over 1 trillion annualized, up from 322 billion in the same period a year earlier. So, the US is paying $1 trillion a year in interest before any new crisis. On top of that, roughly $9.6 trillion of marketable US debt matures over the next 12 months. That means Treasury must refinance $9.6 trillion at whatever rates the market demands, still fund new deficits on top. If rates stay high, interest costs explode further. If rates are cut hard, it likely means something in the economy or markets broke. Either path is friendly to gold's long-term role as a hedge against fiscal and monetary strain. Segment 10. Risks and how not to get wrecked. Even with this backdrop, you can still get crushed if you ignore risk. Real risks. Gold at 5,000 is stretched on many timeframes. Sharp corrections are possible. Silver at 70 plus remains highly volatile. 10% down days can happen on thin liquidity and headlines. Shanghai is closed during holidays, which sometimes invites Western banks to push prices around without China's bid. China's reforms and any future U.S. stockpile are policy paths, not done deals everywhere. The U.S. has extended big imbalances longer than critics expected before, so the message is not go all in, max leverage. It's the structural case is strong. The short-term path is wild. You need position sizing and time horizon that can handle that. Segment 11, how to position in this new phase. Here's a simple framework. Separate trader brain from investor brain. Trader brain respects support, resistance, watches Fed and data dates, takes profits on parabolic moves, cuts losers. Investor brain looks at debt math, central bank buying, refining choke points, and uses big dips over months as accumulation zones. Prefer some real metal exposure. In a world where China is attacking rehypothecation and demanding delivery, the gap between paper claims and physical gets more important. Don't bet against arithmetic, $1 trillion in annual interest. 9.6 trillion rolling, persistent deficits. That's a structural case for some allocation to gold and, by extension, silver. Accept volatility as the ticket price. The moves that take gold from 2,000 to 5,000 and silver into squeeze territory don't come with gentle charts. You're not early 2001 style early anymore, but you're not in 1980 style blow off either. We have a first ever 5,000 weekly close without full ETF participation and with central banks still buying. You've been watching John AG here, and I'm OG John AG. If this helped you understand why a 5,000 weekly close with fake headlines and Chinese paper crackdowns is the start of a critical phase, not the end, hit like so this kind of breakdown doesn't get buried. Subscribe and turn on all notifications, because if the next 12-18 months really are the compressed gains window for gold and silver, you'll want to move with a framework, not with fear.